in tech, little sell-off in the dollar. I think it feels like a pause rather than something that's kind of significant. I think everybody's just tired.
Yeah, and you can really see it too for next week when you have CPI here, and then you also have ECB. So those two events maybe will move the narrative to what we've already started changing the narrative. Maybe that helps advance that narrative, but I'm not sure. And in terms of positioning, I always come back to this, but how are we set up then for next week? Like, what has been shaken out over the last 4 trading days?
I also think the other thing that's changed as well is what is happening in commodities. The oil story in particular really strikes me as being quite significant, and I think it's going to have a lasting effect too. If oil prices stay higher, does that reinforce the higher for longer narrative?
Yeah.
Can central banks really be cutting? Today, we're up to 40% chance of a hike from the ECB. Now, that's been moving higher and higher over the last few days as well. Are central banks really going to be cutting? There's that whole kind of narrative around that developing, the higher for longer story creeping in, the tech sell-off, what's happening in the bond market. There's a lot in flux at the moment.
Yeah, and then
takes us to our question of the day.
Okay, fine, you go. No, go ahead. I'll talk about oil later. No, please go.
Okay, I knew you'd be excited about that. I feel like I haven't given you true opportunity. Believe you me, there will be one. Has the narrative changed again? Joining us now to discuss, Mike McKee and Ira Jersey of Bloomberg Intelligence, our chief rate strategist. Mike, what do you think? Do you feel like something's changed this week?
Not really. I mean, obviously, American football started last night and the kids have gone back to school, so we've tipped over into fall. But beyond that, I think we know what we knew beforehand. Maybe we get a little bit more confirmation. Certainly, Fed officials who have been speaking this week endorsing the pause idea for the month of September, and ECB officials speaking this week have basically said, we don't know, but we still think maybe we need to do more. And so you get the markets leaning in those directions, but I don't think that's completely different from what we've seen in recent weeks.
Ira, what do you think? Has the narrative changed?
Yeah, so I think Guy's point about oil is an interesting one, right? So part of the narrative, and I'd say that I agree largely that, look, the narrative didn't completely shift this week, but I think around the edges there's a little bit of nuance that has. And one of the things that higher oil prices means, and if you see this in like next week's CPI forecasts where you have 0.5% expected on the headline, but only 0.2 on core. So will we see higher oil prices contributing to inflation more, number one, and then number two, that ends up being a tax on the consumer in many ways, many respects. So I think there's a narrative coming in that maybe that means slower real growth, and that's bad for risk assets and probably good a little bit for the rates market.
Alex, I think maybe one of us needs to be the equity person here. You got Mike on the macro, you got Ira on the rate side. Maybe what changed this week is not in those two places, and I'm wondering what the ripple effect into those places is though. What changed maybe this week was that this epic rally we've seen in tech got called into question.
Yeah, it was already happening, right? Like there was still over the last couple months the NASDAQ not performing as well.
Apple's been battered over the last couple of days.
Yes, but I also wonder how much of it's like truly shaken out, or we just need to de-risk some of it. I mean, and I feel like those two things are fundamentally different. But where I think maybe if you have oil and Apple intersecting is on the consumer, as Ira was pointing out. The difference between oil prices now and say a year ago when we had high prices was excess savings. If that's come down, there's less to offset that spike in gasoline prices, and then do you really shell out $1,000 for a new phone?
Maybe not. I wonder whether the Apple story is a China story though, or maybe that's the other bit of the narrative that has changed. There is this kind of fear growing that maybe actually the China economic recovery is not going to come. I think we probably already knew that, but also that we've put this tit for tat kind of confrontational relationship back on the table. Raimondo's been there, and it's felt like the Chinese have wanted to kind of have a few digs, and this new Huawei phone, I think, is significant. Ira, the China story we knew it was slowing down. We knew that there was going to be an impact there. But if we're putting back geopolitical risk into the mix, how does that feature into the rates market? Does it feature in the rates market? How does it work its way from China into Apple into rates?
Yeah, so I think it's just largely a risk-off event, right? So that would not be good necessarily for equities and would be good for the rates market. And yeah, you know, I think the more political risk you have, and if you have another trade story that winds up being another hit on the consumer, you know, you could have a stagflationary type environment where it becomes a little less clear about where asset markets would necessarily go this time. Thinking about the rates market, like what happens if we get stagflation and inflation remains high, but growth is slow.
Yep.
You know, how do rates react to that? I think is significantly different, and I think it's clearer what happens to risk assets. I think you get wider spreads in corporates, you get lower equity market in that environment, but the rates market gets a lot more muddied.
Okay, so Mike, it feels like from that perspective things have changed a bit. Oil, Apple.
Well, I'm less concerned about Apple in the sense that what you pointed out. I saw a story today that said the iPhone 15, the high end could go for $2,000. That's not excess savings. That's just expensive no matter what. So I don't know if that's a good judge of where the consumer is going to be. Oil prices are obviously something to keep an eye on, although according to AAA, gasoline prices have continued to fall all through this rise here. So maybe we are seeing a very delayed impact of that, and that may be part of the reason that people are forecasting trouble in the fourth quarter, along with the student loans situation. So we have to wait and see on that. The interesting thing about China, though, is that we knew that they were slowing down. But what we don't know is really how badly and what tools they have that will work to fix it this time. And their economy is so opaque that it has got to be hard. It has to be hard for investors to try to figure out how you play that at this point.
I thought it was really interesting this week that you saw Richemont, the European luxury company, its boss coming out and saying that high inflation is starting to impact upper-end consumers. I'm assuming it's those upper-end consumers that could also be buying iPhones as well if they are priced at the kinds of levels that you're talking about, Mike. We'll wait and see. We'll find out maybe in a few days' time. Ira, can I just come to you on another thing that I thought was interesting as well? Michael Hartnett over at Bank of America was raising the idea, which I thought was fascinating, that rates go higher if we get a recession. And this is something that I wonder is going to start creeping in as well. His basic notion was that the stabilizers kick in, you get a recession, government panics, spends even more money, and as a result of which you see even higher rates on the back of that because the market's not going to tolerate it, even if the Fed would be cutting. What do you think about that?
So traditionally, supply has been pretty exogenous to the Treasury market, and generally speaking, when you get a lot of supply, it's because the economy is doing poorly. You wind up getting lower inflation, and the macro really pushes yields down. I think I disagree with that view. I think that you would get lower Treasury yields and a rally in the Treasury market, but maybe it's not as severe if the supply aspect is going to hold back some of that rally. So, for example, instead of 10-year yields going from 4% to 3%, maybe they only go to 3.25% because of that additional supply. And we actually have some of that built in our models as well.
And I would also argue, Mike, you covered DC back in the day. Like, I can't imagine there would be fiscal stimulus even if there is a recession. Like, after all the money that's been pumped in and how high inflation is, that hurdle feels crazy high.
Yeah, when Guy said, Michael Hartnett was saying that the government spends even more money, I was thinking, which government are we talking about?
It can't be the U.S.
That's not going to be happening in the U.S., and certainly not in 2024. Automatic stabilizers do kick in, but the extra stabilization that the government put in place during the COVID crisis is not going to be there anymore, and the extended unemployment benefits are going to be harder to get through Congress. So at this point, you're sort of on your own if we do go into a recession, which is why it would be a good thing if the Fed can avoid that.
All right, guys, really, really interesting conversation. It seems like stuff did change. Michael McKee, Ira Jersey, Bloomberg Intelligence, thank you so very much. Happy Friday. All right, coming up, it's more on our question of the day. Has the narrative changed again? Leslie Falconio of UBS Wealth Management joins us next. And as we head to break, let's take a listen to New York Fed President John Williams, who spoke to Michael McKee on U.S. monetary policy.
Right now, I think, things are moving in the right direction. We've got policy in a good place, but we're going to need to continue to be data dependent, watch the developments, and assess what we need to do.
CPI next week can definitely change it, not September, but can change the next rate hike at the end of October, beginning of November. This is a very complicated time for the Fed, and markets should not jump to conclusion too easily as to what's going to happen beyond September.
That was Bloomberg opinion columnist Mohamed Al-Arian speaking earlier on Bloomberg TV, which brings us to the question of the day. Has the narrative changed? Again, joining us now for her take is Leslie Falconio, UBS Global Wealth Management, Head of Taxable Fixed Income Strategy. Leslie, what do you think? This week, has the narrative changed?
You know, I don't think so. I think the adjustment to the narrative has been happening over the past several weeks, and you've seen this in the marketplace, not just with the reaching 436 and 10-year yield, which is the cycle high, but also the amount of repricing for future Fed funds and the amount of easing that the market has taken out. So we've gone from, say, 150 basis points of easing projected in 2024 just a month ago to now maybe just over 100. So I do think that the market has shifted, but it's shifted earlier to now people accept the fact that more than likely we won't go into recession, but there may be a little bit too many people in that soft landing camp.
What do you think of the sell-off we've seen in tech, the tell-off? That's not really what we're seeing. The sell-off we've seen.
You know, look, I mean, I think
you never know.
I think that would be expected. I mean, for our equity, team, we're expecting actually more of a range-bound environment, and they've sort of taken out that recession expectation. I mean, tech has done fairly well, so it's not surprised to see somewhat of a sell-off. But we're looking for the equity market to actually be fairly range-bound over the rest of the year.
So, which begs the question, like, it feels like tech has changed, but then you look at the year-to-date performance, and NASDAQ 100. Has still crushed it versus the S&P and the Dow. So I wonder how much of the narrative has changed versus just a blip and disrupted.
Well, I mean, I don't think it's necessarily a full change in that narrative as much as people are thinking that there's just simply overvalued and they're expecting a correction. It's definitely outperformed than what we expected, and that's why, when it comes to the tech sector overall, we're a little bit cautious on that. But for the longer term, it might be fine. But for short term, I think it's been a little bit overvalued, particularly when we think about what's happened with AI.
Mm-hmm.
Leslie, oil prices are moving higher. You're going to see that in the CPI next week. Is this something that's going to accelerate potentially a recession, potentially bring forward a hard landing? Or is it a reason for the Fed to keep rates higher as it's likely to bleed into the inflationary numbers and keep the headline figure elevated?
I would be more concerned about the rise in oil if, in fact, the market hadn't already corrected. But I think next week's CPI, the headline is expected to be fairly high. We'll see what happens with the core. I don't think what happens, with next week's CPI is going to alter the path of the September meeting, which is, more than likely, no rate hike unless it really comes in surprisingly above consensus. I think the impact would have been greater if the market hadn't already repriced. Mm-hmm. So I think we have to see what happens sort of like over that longer term. But for the short term, I don't think it's really going to have that much influence given where the market's priced to already.
So, Leslie, Guy brought this up in the last segment. Bank of America, Michael Hartnett, in his weekly note, talking about how yields can go higher if there is a recession because you're going to have a stimulus coming in from the government because they have to support, when you have a recession, higher yields and oil all crimping the consumers. Do you agree with that? Or are we just in for a world where you just got to buy treasuries for safety instead?
Listen, your last guest brought up a really important point, which I completely agree with. And if we look historically, right, when the Fed pauses, even after a hiking cycle and we have a soft landing, whether we have a hiking cycle and a hard landing, when the Fed pauses, interest rates have a tendency to go lower. But what your previous guest brought up, which I completely agree with, is that because of the amount of supply that we're seeing in the market, the magnitude of the decline will be less. Right? The trend will be the same. Yields are going to come down, but the magnitude might be lower. I just can't see right now how that would cause interest rates to rise. So I can't say I perfectly agree with Mike, but I do think that the trend will be much less than what we've seen previously, just simply because of the supply that the market has to deal with.
So are we going to be, what does that higher yield world look like for other asset classes? How does that bleed in to the rest of the markets?
Look, I mean, one of the benefits about fixed income, and we know this, I mean, if you look at the long-term total return driver for fixed income, it's income, and it's compounding income. Mm-hmm. It's not whether or not the 10-year goes up or down 50 basis points. It's not price. So I do think that carry component of fixed income is very important right now, and I do think that locking in, and we've locked in at that 4% and higher, over the longer term, as you compound, will really be beneficial. There's a lot of cushion that certain sectors, although it's particularly in the credit side. I wouldn't say that they're cheap by any stretch, but you still have that ability to have that cushion and compound that income over a longer period of time. So I think that, given if yields stay where they are right now, I do think you're going to continue to see, sort of that higher quality bias because over time growth will slow.
Well,
and I think that's the, go ahead, I'm sorry.
We've also just seen, kind of to this point, money just continuing to flow into money markets. I think the cash now is like 11.7%. Where should that be allocated if it's not just sitting in a money market fund?
Look, I think you can't ignore the shape of the yield curve, right? And we still think, we've projected a steepening in the second half of the year. We still think that we do steepen, but we're going to remain inverted until most likely 2024. So, that sort of capital preservation, the short end, we don't want, and that liquidity that you have in that short end, you shouldn't dismiss. However, as we all know, when the Fed pauses, the market is forward-looking. They have a tendency to price in those eases much faster, and you are subject to a lot of reinvestment risk. That's why you should have a bit of both, and that's why we have that barbell strategy on to to have advantage of that capital preservation, liquidity, and yield in the short end, but also start locking in around that 7 to 10 year.
Hey, Leslie, really great stuff. Oh, no, go ahead, Guy.
Sorry, no, I was going to, one quick point on that. So am I buying bonds for sort of increase in the capital, or am I buying them for yield? Or is it both?
It's actually both. In our sense, we do believe that interest rates go down, so you're going to have a little bit of price appreciation. You're not going to have a huge amount of spread compression because we know, spreads are relatively tight, particularly on the corporate side. But you are going to lock in and reinvest that carry. So I think it's a little bit of both.
All right, Leslie, we got to leave it there. We super appreciate Leslie Falconio of UBS. Thanks a lot. Sort of apropos to this conversation, Guy, Kroger is on an earnings call right now. A couple things that stand out for me. The CEO saying it's gaining business from higher income customers and lower income shoppers are under rising pressure. You did see a spike up, but we're losing some of that gain. The spike up was because of some offloading some stores in order to do a merger. But that, I think, says it all, right? Lower income hurt, higher income going to Kroger.
Well, it just fits with everything. It almost fits with the Richemont story, doesn't it, this week?
Yeah.
Even higher end consumers are not going to be buying luxury. Are we going through a period where 10 years of excess, as we heard from Richemont, is going to take a long time to unwind? Is that the process we are going through? You hear the travel industry talking about it, you hear the luxury industry talking about it, you certainly hear the grocers talking about it as well.
Yep, and you're seeing credit card delinquencies start to pick up from that too in certain income levels, so there are those things percolating now. Anyway, still ahead, speaking of other things and high-end stuff, Apple iPhone and also Huawei. After a week just to unveil, what am I saying? Made in China smartphone, here we go, read the prompter, Alex. Huawei surprises today with an even better phone, and this is just days ahead of Apple's big product event. So we're going to get more on the startup next. This is Bloomberg.
About that all day yesterday.
It is 22 past 7 on the West Coast. We want to get to the startup, but we cut the top tech stories from the Bay Area. Well, that's a really beautiful shot as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ledlow. Ed, it looks really pretty there, but it can't feel really good after Huawei just unveiled another new super cool phone.
Yeah, I mean, this story has just been incredible this week. The latest is that the U.S. Commerce Department is now going to investigate how Huawei was able to put together the Mate 60 Pro. For our audience this week, what happened was that Bloomberg News got hold of Huawei's latest handset from China, the Mate 60 Pro. We took it to a firm called Tech Insights, who did a teardown, and they found within it a 7 nanometer made processor from Semi Manufacturing International, China's basic leading chip maker. But it had all the hallmarks of a processor, even though it's 2 generations removed from the latest tech, 3 nanometer, that is subject to US sanctions. And so that's what the Commerce Department is now doing, looking into whether there is a breach of sanctions here from any of the players involved.
Is it significant that this phone has been unveiled this week? Raimondo's been there. Is it significant that this phone has been unveiled at the same time as there's a pushback against Apple?
Yeah.
Is this politics?
It's incredibly hard to draw together the chronology of this week with the latest technology from Apple that's coming next Tuesday and Huawei. The phone was released by Huawei mysteriously because it wasn't registered officially with China's regulator the week that Gina Raimondo was there. Then, as the Wall Street Journal and Bloomberg News reported this week, China's central government mandated to other government agencies and state corporations that their staff should not use iPhones from Apple or other handsets from a foreign country. Then you have next Tuesday, Apple revealing the iPhone 15. You know, the timeline is incredible.
Yeah, I feel like, Ed, the iPhone 15 unveil and the price tag in this particular moment in time, considering you can get a Huawei phone for like under $1,000, really interesting.
So the question is, like, does the Mate 60 Pro take market share from Apple in China? China's so important for Apple. It was one of the few areas of growth in the June quarter, top line growth of 8%, and executives talked about the iPhone being at the heart of that. There's also a technology story. Read Mark Gurman's preview of what's to come next Tuesday. The latest iPhone 15 Pro will have an A17 chip. That's Apple's proprietary silicon made on 3 nanometer technology. So the other way to look at this is Huawei's come out with a surprise phone, but it's 2 generations behind Apple in the processor. And as we reported, they sold out straight away, which indicates China's not even producing at 7 nanometer level at scale or volume.
Oh, fair enough.
Ed, the European luxury companies are talking about the fact that consumers, even high-end consumers, are starting to feel the pinch. Do you think Apple's going to have the same problem?
Well, Apple talked about it. We've had 2 quarters of contraction for the smartphone market in the US, and Apple operates at the higher end of the scale. Right, so if they're talking about that, it is happening here, at least in this Western economy. I would say that the June quarter was a record for Apple on the smartphone side in China and in Europe. So that's interesting as well. You know, we know that consumers can be more selective in tough economic conditions. Is the hardware upgrade for Apple good enough to convince a consumer to part with cash? That's, again, a technology story that I'll be checking out next Tuesday.
And are we getting to the end of that form factor? What happens next? Ed, great stuff as ever. Ed and Caroline, Bloomberg Technology, coming up in around 90 minutes' time. This is Bloomberg.
We're about an hour into U.S. trading session. Yes, equities are up. Volume isn't great, though. I'm a little pooped, and I really do feel like the market is, too. Abigail's tracking the moves. Abby?
It has been quite a week, but we do have a little bit of a reprieve here for stocks. That S&P 500 up about 0.5%. The NASDAQ 100 doing a bit better, up 0.7%. Yields in a little bit, maybe helping stocks on the day. It's not a big move lower for yields, and of course, it does mean bonds are higher, but we're in this phase where when yields go down, maybe investors are a little bit more encouraged that liquidity will stay in the system. Crude oil up about 0.6%, and energy is the only sector on the higher on the week, I should say. On the week, in fact, we have the indexes down, the S&P 500 down more than 1%. If we take a look at the S&P 500 tech sector on the week, this really kind of paints the story. It hasn't been a great week at all, down 1.5%. This, of course, on the Apple story of China banning their phones, the iPhones, in certain settings. That has really taken a lot of air and steam out of the markets on the week, especially for tech stocks. Let's take a look at some of these declines because they are pretty significant. Broadcom down 1.5%, an Apple supplier. NVIDIA down 5%. September last year down 20%. September the year before down about 7.5%. This September starting off in a bearish light as well. Of course, the stock is still up more than 200% on the year. Apple down 5.2%, and Qualcomm, another Apple supplier, down 7.4%. So some of these tech and chip stocks really getting hit. What does it mean for the S&P 500? Let's take a look at a super simple chart, a pretty chart, if you will. And you can see the S&P 500 is climbing higher on the year, a beautiful uptrend. All of the moving averages, well, I shouldn't say all, actually. The 200 and the 100-day moving average is climbing higher. Take a look at the 50-day moving average flattening out. Now, the S&P 500 went before below. It's gone now currently still. It looks like it's going to try to go back above. And there is actually an uptrend holding here. However, Guy, you have to wonder, with Apple not being just below its 50-day moving average, but also below its 100-day moving average, you have to wonder if the S&P 500 may just consolidate more, especially given the fact that September is the seasonally most difficult month of the year.
Certainly turning out to be so far. Abigail, thank you very much indeed. Abigail Doodle on what's happening with these markets. Let's turn to what's happening with the political story. The US President Joe Biden holding a bilateral meeting right now with the Indian Prime Minister Narendra Modi. Bloomberg India senior editor Menika Doshi joining us now from New Delhi. Menika, let's talk a little bit about what we know about this meeting going into it. It's because it's behind closed doors, isn't it? We're not expecting an instant readout, but what do we think is going to happen here?
Well, to the best of our information, Guy, the meeting is taking place at Prime Minister Narendra Modi's residence. We have no information on the talking points between the two leaders as yet, but we do know that President Biden touched down into India just a short while ago, and this is the first bilateral that he is doing with the host of the G20 summit. Now, given that Prime Minister Modi not a long time ago returned from what the Indian government described as a fairly successful trip to the U.S., an official visit to the White House, and given the fact that Treasury Secretary Janet Yellen is now making her fourth trip to India, I think all of this underscores a degree of strength in the U.S.-India relationship. And much of that strength also comes from the isolation of China, or as critics would put it, the self-isolation of China. So these are some of the ingredients in the mix. I imagine China will be one of the key talking points between the two leaders, both the slowdown in the Chinese economy, but also the political aspects of this. And they will also talk or continue talking about defense partnerships, manufacturing partnerships, partnerships regarding digital public infrastructure, and a variety of other issues.
Where does it leave the G20 then overall? What are some deliverables that Modi wants to show?
Well, Alex, the G20 is taking place in the backdrop of, a variety of things that you all have been discussing through the course of the day. A strong dollar, yes, of course, but the continuing Russia-UK war, food supply concerns around high energy prices, and the slowdown in the Chinese economy. In the foreground of the G20 summit, and these are some of the areas that leaders hope to come to decisions to, is reform of multilateral development banks like the World Bank, debt restructuring for lower income countries, and transition financing for climate change. all of this is in the mix. We're hopeful that there will be a communique by Sunday evening. But of course, as you know, the sticky point in that communique is the language around the Russia-Ukraine war. From now, so far, as Bloomberg scooped, we do understand that the communique will talk about a cascading of crises, will talk about coordinated macroeconomic measures, including fiscal and monetary policy measures, but we don't know yet what's going to happen with regards to the language on the Russia-Ukraine situation.
All right, Menaka, thank you so much. Menaka Doshi, Bloomberg India senior editor, thank you so very much for joining us in New Delhi. So there are a couple of really interesting labor stories, Guy, that have kind of been kicking around. And that kind of sets us up, too, for President Biden when he gets back and has to deal with the potential auto strike. But one is Walmart. So this is a really interesting piece from the Wall Street Journal. Apparently, Walmart is now lowering its starting pay for some new hires. And the move is part of a revamped wage structure that took effect in July. Walmart says the lower rates will affect newly employed shelf stockers and online order pickers. If the job market's super tight, would you be doing that?
The job market clearly isn't super tight. That's got to be the message from this, isn't it? If they were still struggling to recruit and were finding that difficult, then I think you'd be in a situation where they would have to be increasing pay, but they're not.
You have to wonder,
By
though,
extension, you think that maybe things are starting to come more into balance.
Now, they say it's because if they do that lower pay to come in, you can move from different departments more easily, so there's maybe more career advancement without having to increase the pay. I don't know. I take that with a little bit of a grain of salt, I guess. But if the labor market's not that tight within retail, but then what about the auto workers? That would say the market is still really tight.
Different markets, though, isn't it? Unionized, not unionized. And that seems to be the big difference at the moment. If you, which is why I think it's interesting to see where companies are setting up in which states, right-to-work states, etc. The union power is clearly there. The unions are flexing their muscles. Joe Biden, in some ways, has set himself up for some really difficult stories here, I think, to develop. But if you are a union, now is the moment to strike. But at the moment, it looks as if the labor market is beginning to right-size a little bit.
Yeah.
Maybe that power, therefore, won't last.
Yeah, so you're at that peak, absolutely. Here's another labor story on like the totally other end of the scale. So according to the FT, Goldman's going to dismiss some underperformers as soon as next month. Goldman managers have started drafting lists of those who may be cut. The final numbers are still being set. And back in January, the bank had its biggest round of job cuts ever, eliminating about 3,200 positions. Now, Guy, from what we understand, it's not like more people. It's maybe on the low end of the normal layoffs, but it is earlier. I wonder what that means.
I don't know. Maybe it doesn't mean anything. Maybe it just means that they're coming out of a pandemic. The banking labor market, I think, is really difficult at the moment. And I think trying to draw conclusions that when we've been through such a turbulent period, I think is really difficult. And I think Goldman Sachs clearly wants to get some go forward right now. Maybe it wants to hire some more people in key areas. Maybe it's therefore looking to lay off people a little bit earlier and make that move a little bit earlier. I don't know. I think the timing I find a little bit questionable. Bonuses are also down. I think there is definitely a morale issue. It was really interesting to hear what Solomon was saying about the caricatures of him recently, but clearly there is a morale issue. Pay is down. I'm just not sure about the timing kind of narrative around the fact that it's come a little bit earlier. Is there something significant there? I'm not sure.
I guess it depends also what business line, too. Like if it happens in investment banking, even though the capital markets are kind of opening again, like that would be kind of interesting. Anyway, so we'll wait and definitely track that story. Coming up now, though, we will look at some short-term Treasury bond flows into ETFs. We're still hunting for yields. Cash positions super high in money markets. More on ETF Friday coming up next. This is Bloomberg. let's turn to ETF Friday. Why not? Because we are seeing a lot of flows, as I mentioned, money market funds hitting a record high, the money coming into that, like 11.7% now of money is just sitting in cash. And that is echoed in ETFs. You got flows in short-term bond ETFs are staying pretty steady as investors are reaching for those yields. Bloomberg's Emily Griffeo joins us now for ETF Friday. Emily, walk us through just how much suck these ETFs have been seeing.
They've been seeing traders kind of pile into cash-like ETFs at the fastest pace that they did back in February when we had that really hawkish Federal Reserve, and we also had in March SVB. We're seeing in August cash-like ETFs tracked by Bloomberg Intelligence pulling in $7 billion in total, and the flows don't seem to be stopping into the first week of September. When you look at SGov, which is BlackRock's 0 to 3 month Treasury bill ETF, we're seeing 4 straight days of inflows in the past week into that fund. So billions of dollars of traders kind of reaching for yield here, and you can see that it has picked up on that chart there. During February and March, people were piling in, then they kind of backed off, equity markets rallied, and now we're back to safety.
Emily, vol is low. What does that mean for ETFs?
Well, volatility is low, and traders like to use ETFs, particularly SPY, the first ETF from State Street that tracks the S&P 500, to kind of play with volatility. But Susquehanna had a really interesting note earlier in this week talking about how any investors who have tried to play an options straddle, which is a bet that would pay off if the ETF moved in a really big direction, either to the upside or to the downside on macro days. So think CPI, non-farm payrolls, FOMC, they've actually lost money trying to play that big vol spike because we actually haven't seen since about July the market move that much on these big macroeconomic days.
It's amazing, isn't it? Everybody's getting caught out by that one. Emily, great stuff. Thank you very much indeed for joining us on ETF Friday. Emily Griffeo. Coming up, we're going to look at challenges facing the private equity business. Sachin Kajuria, Achilles Management founder, joining us next. Janali's going to be here as well. It's going to be great. This is Bloomberg.
your Wall Street beat. We take a look at what is buzzing on Wall Street and the world of banking and finance. And there's a lot out there. Today we're going to take a deep dive into the challenges facing private equity. Sachin Kajuria is Achilles Management founder and former partner over at Apollo. He joins us now. He's also the author of 22 and 20, How the Masters of Private Equity Always Win. Bloomberg Schley Bassett joins us as well. Sachin, great to see you. Thank you for joining us.
Thank you. Thanks for having me.
Are they winning for real? I thought like defaults were picking up, exits are really hard. Is private equity really winning?
I think the good ones are winning. I think definitely the market is a little more old school now than it used to be. A bit similar to when I was an analyst, let's say 25, 27 years ago. You don't have huge help from the Fed. Interest rates are more normal as opposed to zero. And so, the business of buying is definitely more difficult. But I think the good ones are doing it well that have scale. I think one of the challenges now where investors are focusing is actually monetization. Those who can sell. Those who can't, maybe they're not selling as well. And that's something that I'm seeing increasing focus on because, obviously the business is selling as well as buying.
So the other reality of this is not just monetization, it's this idea that private equity bankruptcies are at a 13-year high. But have we even seen the worst of it yet?
I think you have to wait to see how the macro picture evolves. There's unquestionably a lot of deals which probably were done with, optimistic assumptions, capital structures, and so on. And a lot of that's coming home to roost. But I think that you have to be a little bit more selective than that. Look at individual firms, individual funds, and you'll see really who's performing and who's not. And that's why I think not only will there be a thinning of the herd, I think investors will be a lot more discerning the next time there's fundraising rounds to say, well, how did you do in the last vintage and the vintage before that?
It's interesting because a lot of these private credit firms are raising billions of dollars, Oaktree coming in with a record fund. But when you're looking, I know you invest in a lot of funds, private credit, private equity, are you confident here that they will succeed in finding the best bets? At the end of the day, and not just Oaktree, just across the private credit landscape, these are risky companies.
So I think there's a lot of nuance to the commercial. You're probably hearing the private credit commercial a lot. I mean, there is a secular shift, which is great. And I think, a lot of bank lending, it's low in the US. Most lending is not bank lending. And so I do believe in the growth of private credit. But there's a lot of nuance there because remember, especially if you're doing the riskier parts of the capital structure, it's a cyclical business. We're more likely in the economic cycle to be looking down rather than up. So when you really layer in slow or no real growth, you have to be pretty selective. I definitely wouldn't have, fear of missing out and just backing up the truck and buying everything that's coming out. So I do think that just as you would with a distress cycle, we're not in a distress cycle, but just as you would with the distress cycle, you have to be a lot more selective now and look. And that's why, you're talking about private credit. I would much rather be in the senior end of the capital structure now than I would be, further down, unless of course you've got a very opportunistic deal where one private equity firm has lent to another, it hasn't gone very well, and they're able to extract very good terms.
Sachin, good morning, it's Guy.
Hi, Guy. How are you?
We're looking down. I'm very well, nice to see you. We're looking down, we're not looking up. How down are we looking?
That's a very tough one. I mean, I think, I'm not sure we have right now enough data to say that there's going to be a sort of deep recession or something. But I mean, it certainly looks like low growth, slow growth, and with high rates, that might be enough to tip a lot of companies the other way. And so I think we're looking at, maybe it's worse in Europe than it is in the US, but we're looking at challenging conditions, and that's why when you're investing into a levered capital structure and we're looking more down than up, I'd certainly be very selective and not have this kind of fear of missing out as a private credit fund that's rush into it. I'd certainly be a bit more selective.
Is private equity the right word to be using for funds like Blackstone? Like, is it a private equity fund anymore? Like, some of these, you said you need scale to help in this environment, right? And that private credit's going to be okay if you're at scale. So are private equity funds that are doing all the things like investment banks now actually private equity firms?
Well, I just think you can't think of private equity firms, you talk about Blackstone or any of the other major ones, as, one-trick ponies anymore. They've built an ecosystem where they're got flexible pools of capital, they're raising different kinds of pools of capital. And so because they're now mainstream, they're able to go where the action is. If it makes more sense to do private credit right now, that's what they'll do. We're seeing different changing investor allocations right now to private equity. The secondaries market is picking up a little bit. Some investors need liquidity, a bit of a scramble there, a bit of a change in allocation. So I think you have to look at them as mainstream firms that do a lot of different things, and those are the ones that are breaking away from the pack.
Is there a chance that there could be a broader shakeout in this industry? What does a private equity firm failing look like in this environment? Because the reality is you have Blackstone, stock is on a tear, fine. Everyone can't be Blackstone, and to Alex's point, you also have them diversifying in many, many ways, whereas you have a lot of pure play players where they're facing a very different operating model, as you were talking about earlier. Higher interest rates, lower valuations.
Yeah, so look, if you have a real niche and you're really good at it, like technology, then I think you have a lot going for you. But I think if you're a reasonably generic firm, it's going to be a lot more challenging because the conditions are just tougher. And so, I think that, the herd is going to thin. I think that you're going to have more and more concentrated LP allocations, maybe increasingly to the major firms. In other words, the big keep getting bigger, unless you have a real expertise. And that could be any kind of expertise. It could be size, it could be a sector, it could be product, but you're going to have it.
The other thing you need is leverage. And you finally see the leverage loan markets trying to squeak through the gates. Do you think that these banks will be successful in offloading all of these deals that they hope will come to market in the next couple of weeks? There's $15 billion in the pipeline now.
So as an investor, I would definitely wait a little bit and see how things shake out. I think that the market's open. Who has a crystal ball when it's open again? Just because it's open, I wouldn't pile in. If you have the choice, a lot of liquid credit funds just have to buy. But I would definitely be waiting because I think, as we get more data on the economy, as the economy is coping with higher interest rates, not just for, 6, 12 months, but let's say 18, 24 months, we'll have a lot more news on, where the right opportunities are.
Sachin, if we go through a downturn, is the word private going to be useful? i.e., can things happen behind closed doors that will allow this industry to weather it? Or is the fact that the private market is so big now that actually that advantage begins to disappear? I'm just kind of wondering what is going on below the sort of behind the scenes at the moment. What do conversations with LPs look like? What do conversations with portfolios look like? Is that private story going to be good enough to allow this industry to kind of extend and pretend is the wrong way of putting it, but have time to be able to manage some of the difficulties?
Well, it's always been the case, Guy, that if you have heavy lifting to do and the public markets are not hospitable either to the work you need to do or to you generally, then it might make sense to come out of the public markets and work with a private equity firm, a management team, and so on, to do your homework in private. And I think that that's just going to increase in the coming years. So because we have private credit or non-bank lending facilitating buyouts increasingly, providing deal certainty at a higher cost, but remember, when you have a private credit firm or fund that's financing a buyout, not only do they speak the same language as the private equity fund, they speak the same dialect, right? And so I think you're going to see that opportunity increase, and I think you're right that we will see a lot more of that going forward. As long as you can get deals done, as long as you can narrow that bid-ask spread on valuation, you're going to see more of that.
Sachin, you mentioned that you would wait for some of these leveraged loan deals, but what are you actually buying in this market given the dislocations we're seeing?
So I think private equity, there are always great deals if you pick the right funds, but the number of places to look, I think, is decreased. So I think, to answer your question directly, I think definitely, non-bank lending, private credit at the senior end of the capital structure. And then if you're going to be opportunistic, then you're going to look at when those same funds or similar funds are lending to other private equity funds, but typically when there's an element of distress or they're able to extract particularly good terms. So it's idiosyncratic. I wouldn't just back up the truck and everything that's out there. And so, I believe in the commercial you're talking about, but definitely with a bit of a nuance.
Sachin, great to see you. Thanks for stopping by to see us. We really appreciate it. Sachin Kajuria, Achilles Management founder, and of course, Bloomberg Shanali Basak. Okay, we're coming into the end of the week here in Europe. We're about to close the markets down for the weekend. Stock 600 stabilizing a little bit, but it's been in such a tight range recently. I'm not sure there's anything we get from the index. The one interesting story that stands out for me this afternoon, Arnaud is backing up the truck. He is buying LVMH stock right now. There's a great story on the terminal. Look at what is happening. LVMH bouncing a little bit today. Euro dollar bouncing a little bit as well. Today just feels like an exhaustion day. We had such a massive week this week, despite the fact it's been short for the US. Euro dollar up by 0.2%. The strike has started. The partial strike has started in Australia for nat gas. It's rippling into Europe. We're up by 4.29. Remember, Europe doesn't buy gas much from Australia, but the Japanese do, and the Japanese are going to have to look elsewhere. It's going to be an interesting story to see how that commodity story gets into the European market. Sebastian Radler is going to be joining us from Bank of America very shortly. That's in the next hour. This is Bloomberg. Friday, the 8th of September. Kind of feels like a bit of a pause today, a little bit of a refresh, maybe, going into next week. It's been a blistering week. Little stabilization, maybe, not much. Europe remains in a tight range, but there's some interesting narratives beginning to develop. But has the narrative changed? The countdown for the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
LVMH, though, a heavyweight, rising up by 2.36%. Luxury's been beaten up recently. The Richemont story this week certainly did not help, but apparently Arnault is backing up the truck, buying the stock, buying the dip. LVMH up by 2.36%. Covestro, the German chemical giant, apparently is prepared to start formal talks with Abu Dhabi's ADNOC, if I can get the words out. That stock certainly surging. Alex, on the back of that news.
So words are hard, and I say that because this has been a really long week, and it feels like things are just a little bit slow, really trading a little bit heavy, and that I feel like everything, all the asset classes are a bit tired. S&P is up 0.2%. There are a couple